Should we go long or short this week? Welcome back to Talk Stocks with me. As we head into the trading week of November 23rd, 2025, let's break down the market's internal health using data, not emotions. By the end of this video, you'll know whether this is a market where professionals prefer going long, strong stocks or shorting the weak ones. First, the VIX, our market fear gauge. VIX is now 23.42, up from 19.82 last week. This is a meaningful jump. Anytime volatility expands as quickly, institutions become more defensive. Elevated VIX means traders demand a premium for taking risk, and that usually creates conditions where breakouts fail more often. And next up, interest rates. The U.S. 10-year yield ticked down slightly to 4.067% from 4.148%. Lower yield should help risk assets. But here's the catch. TLT, the long bond ETF, is not confirming strength. TLT is above the 30-week SMA, but TLT is still below the 50-day SMA and does not qualify for a Stage 2 Weinstein uptrend. So bonds are stabilizing but not leading. This creates an uncertain backdrop, not bearish, but not fully supportive for aggressive long trades either. Let's talk sentiment. Total put-to-call ratio, 0.82 versus 0.83 last week. Equity put-to-call ratio, 0.74 versus 0.71 last week. We're still sitting in a neutral zone, no panic, no euphoria. Traders are slightly more cautious, but these readings do not show capitulation. In simple terms, sentiment isn't giving bulls or bears a clear advantage. And now the heart of our analysis, market breadth. Percentage of S&P 500 stocks above the 50-day. MA, 39%, down from 43% last week. This is weak short-term momentum. Percentage of S&P 500 stocks above the 200-day MA, 53%, down from 55%. Still above 50%, but deteriorating. Percentage of S&P 500 stocks in a Weinstein advancing phase, Stage 2, 45%, down from 50%. This is the most important number of the week. When fewer than half of stocks are in an advancing phase, it means leadership is shrinking. The engine of the market is losing horsepower. Imagine the market as a football team. If half the players were sprinting forward last week, but now only 45% still have momentum. That's a team slowing down. Even if a few star players keep running, the entire offense is getting tired. So what would a data-driven quant shop do with this environment? The answer is clear. High VIX, more volatility risk. Breadth weakening. Fewer stocks participating in uptrends. Bond market not confirming strength. Sentiment neutral, not supportive. This is not an environment where institutions aggressively buy breakouts in hot sectors. Instead, quants typically reduce long exposure, tighten risk, prefer short setups in weak sectors, or rotate into defensive sectors, healthcare. So the bias for the weak, short weak stocks in weak sector rather than betting heavily on longs. If you found this breakdown helpful, hit like, subscribe, and share it with someone who trades. I'll see you next week with another data-driven market pulse. This is Data Vesting. Trading with science, not emotion.